Hi everyone, thank you for joining us today. My name is Eric Jenkins. I'm the account manager for Connecting Up in TechSoup New Zealand. Connecting Up is part of the Info Exchange Group, and Info Exchange is a not-for-profit social enterprise that has delivered technology for social justice for over 25 years. With over 100 staff across Australia and New Zealand, we tackle the biggest social challenges through the smart and creative use of technology. Today, I would love to welcome you to the webinar KPI Tips and Tricks, which will be presented by Mick Devine from KPIs. We'll start with just a little bit of housekeeping here. All the lines are going to be muted, so if you have any technical issues, please type that into the questions box on your webinar panel, and I'll do my best to help troubleshoot that with you. If you've got any questions during the session, please do type that into the questions box. I'll hand them over to Mick, and we'll see if we can tackle those throughout the webinar, which is kind of cool. Do note that your comments and questions won't appear to the entire group, though they will just appear to me. If you're on a Wi-Fi connection and have multiple programs open, that can sometimes affect the quality of the audio and video that you'll be getting. So if possible, just close down those other programs that you've got to help you have the best experience you can. Do note this webinar is being recorded, and a link to the recording and the slide decks will be sent out shortly after the webinar ends. They'll also be up on the website later. There's also going to be a short survey at the end of the webinar, so if you've got any feedback, we'd love it if you would take a few minutes and just take that for us. That'd be really much appreciated. Otherwise, that's it for me from now. Mick, over to you.
Okay, thanks, Eric. Good morning, everybody, or good afternoon to those of you in New Zealand. Welcome. So what I want to do today is talk a little bit about KPIs, and we might first start with why. It seems like a reasonable question. And then we'll look at some financial, operational and cash flow KPIs, and how you create those KPIs in Kelter. We're going to use Kelter to create them, but the basic principles will be the same whether you're using Kelter or a spreadsheet or whatever. It's, you know, whatever tool you need to use, whatever you've got available. But let's go. So why do we need KPIs? Key performance indicators, and essentially they're a shortcut to managing information. Rather than having lots of data, it's about picking out a few numbers and monitoring those over time so that you can manage your organization better. They can be useful for all of those things that boards and management find importance. You can use them for strategic planning, governance, for making sure that you've ticked all your boxes, that you're compliant with rules, regulations, so measuring performance, measuring against budgets, that sort of thing. Accountability, so making sure that your managers of different projects and departments are achieving what they set out to achieve, the targets that you've given them. And when it comes to fundraising, and I use that term generically, particularly grant providers these days are often after that non-financial information. They don't just want to know how much money did you spend in different areas. They want to know what you achieved with it. How many people did you help? They want to know how much did it cost per person, that sort of thing. So number of different reasons why KPIs are important, both internal to the organization, but also, as in that last example, external importance as well. So let's start by looking at some financial KPIs. And some of these will be more relevant to, you know, the not-for-profit sector is very diverse these days, and probably even more diverse than it's ever been, and undergoing, you know, constant change. The disability sector in particular, the aged care sector, has been through a lot of change in the last few years. The sporting associations are going through a lot of change right now with the current crisis. So some of these KPIs will be important to you as a business. Some of them may not be relevant to you, but just pick the ones that make sense to you. And you know, I'm going to talk about a dozen different KPIs as we go through, and it doesn't mean that all 12 are going to be important to every single business out there, but pick the ones that are important and focus on those so that you know what's happening in your organization. Now, debtor days this is about how quickly do you collect the funds that are owing to you, the invoices that you generate. Now, not every not-for-profit, I understand, generates invoices, but particularly in the disability sector now, aged care, there is a lot more invoicing going on. And I've come across a number of organizations in the last couple of years that are issuing invoices both to NDIA and to individual participants who are self-funded, and not having good systems in place to collect those funds. And if they are left unmanaged, they can get out of control and you don't get the money in when you should get it in. And it's a reasonably easy area to improve your cash flow by just putting simple systems in place. And so debtor days is important to manage there. Self-created funds is about funding that you generate yourself. So self-created, self-generated. There's been a move amongst many not-for-profits to try and be less dependent on government grant funding and look more to sponsorship, to bequests, donations, that sort of funding, because government funding is susceptible to the whims and fashions of the government of the day. And sometimes that can work well for you, but there's a danger when it's working well for you that there'll be a change of government in 2 years, 3 years' time, and your funding won't get renewed, or you're sitting there wondering whether it's going to get renewed or not. So there's uncertainty there, and having your own funds that you're more in control of gives you that more independence of the government. Unit costs. So this is about the costs of individual activities, particularly important in those sectors where you've got customer-driven pricing. So like aged care, like disability, there's often, like with the NDIS, there's either fixed prices or maximum prices that you can charge for your services. So you need to understand the costs of those services and make sure that they're under what you're charging, so you're not losing money every time you provide the service. And then net equity is a fairly standard accounting KPI, but it's about knowing how much equity the organization has, which gives you an idea of how much reserves it's got. So let's just look at some of those. Excuse me. If I just bring across my Calxa here. So just a quick introduction. For those of you who haven't seen Calxa before, it's a reporting tool that connects into MYOB Xero QuickBooks and tries to make the reporting process easier for you. Lots of actuals versus budget reports, but also KPI reports as well. And it is available as a donation to eligible not-for-profits through Connecting Up or TechSoup, and there's a discount option, and I'll talk more about that later. But let's go and have a look under my workspace, KPIs. Now, we have some inbuilt KPIs in Calxa, and debtor days is one of those. So you don't even need to set it up. Yeah, and in the handout that I provide at the end, I'll put the formulas that I've used to create all these different KPIs so that you can recreate them yourselves. And whether you're doing it in Calxa or doing it on a spreadsheet, the basic principles of the KPIs are the same. So with debtor days, we're looking at the average days outstanding debtors, and because Calxa connects to the accounting file, we pull the information out of there. And what we're doing here is looking at our trade debtors divided by our debtor income for the last 12 months, multiplying that by 365 to get the number of days. And trade debtors and debtor income here are account groups. And if I go down and find somewhere here, trade debtors is there, and that's my accounts receivable account, and my debtor income is something that we calculate in Calxa based on the cash flow settings that have been set up. It's basically any income accounts where you invoice your customers and don't receive payment immediately. So for those of you who are doing that sort of invoicing, managing those debtor days is really important, but simple formula. So it's just your trade debtors, so the balance of your accounts receivable out of the accounting system divided by the annual income on the accounts that you invoice times 365 to give a number of days. And in my example here, it's generally 3 or 4 days, which means I'm collecting things quickly. It's when it blows out to 30, 40 days that you need to start thinking, how do you put systems in place to get that collection happening faster? Self-created funds. Now, this isn't a built-in one, but so I've just created if I just self-generated funds, I've got as an account group, and in Calxa you just add a new account group and then you specify which income accounts you want to include in there. Simple process, just tick them, and then in my KPI, if I just search for it there, self-generated funds. If I just to give you an example, I'll show you how I create that KPI from scratch. So first thing I do, under functions here, I've got if, because I want to make sure that I'm not dividing by 0. So I'm going to do self-generated funds divided by total income. So I want to make sure total income is not 0. And it's point and click to select these different components. So total income equals 0. If that's true, under components here, constants, I've got null or unknown. And then if it's not 0, then I want that account group of self-generated funds divided by total income. And that's the general principles for, if I save the changes there, refresh the preview, and it will show me the last 12 months at the organization level. So in this example, it's mostly around 7 or 8% of our total income. And I'll show you how to get these on different reports later, but that's the basic principle for how to create a KPI in Calxa. It's very much point and click and fairly easy to do. Now, the next one, the unit costs, if we, not that one, this one should work. So this one is slightly different in that we've involved some non-financial metrics in this one, because you'll see we've got these participants here. So we've got total expense divided by number of participants, and those participants are defined in our budget screen. So if I go to budgets and actuals, and if I just pick one of my cost centers in the budget screen, as well as putting budgets in there in the layout here, if we go metrics per month, and you'll see here I've got number of participants, and this is my budget, and I've got 3,000, 4,000, 5,000 a month. And up here I can also put actuals in for those participants, and I've got actuals entered up until March. You can add these metrics quite easily. You just go add metric, give it a name, and add as many metrics as you need, and enter those at the job project tracking category level, and then you can report against income on that as well. And if I just go back to that KPI just to show you how that KPI formula is created. If I could spell, it'd be better. So it's total expense divided by number of participants. If I just delete that, similar to what we did before, account groups, total expense, which is one of our built-in account groups, divided by components, metrics, participants. So simple process, and refresh the preview, and you get a reasonableness check there by showing the organization level funding. And then net equity, I've just created an account group called net equity. And simply used all my equity accounts there. And so creating that formula is even easier than the others because there's no calculation. You don't need an if statement. And you can search here, yeah. So net equity, refresh the preview. And if I just, somewhere here, I've got a report. I've got to find the right window. We're going to run the report again. I've got a bundle of reports here that I've put together with these KPIs. Report bundles just save all your report settings so that you can just run them all one by one. Instead of running them one by one, you run them all together. Pop that out to another tab just so you can see it. And I'll give you this afterwards just so you can have a look for yourself. And I'll show you in a moment how we get those KPIs onto the reports. So, I haven't done them in the right sequence. I'll come back to that one. Sorry, I changed my sequence. That wasn't very clever, was it? So there's the operation section. So debtor days, I've got comparison of actuals against budget. Self-generated funds. I've got a report here that shows me that by project. So some of my projects have got no self-generated funds at all. Some of them are 100% self-generated, and that's the way things are likely to be. You know, you'll have some parts of your organization that might be fully grant funded, other parts that are funded by donations, sponsorships, that sort of thing. But it's important to know how that fits into the overall picture of the organization. And then that unit costing, so I can see my actuals month by month. And by looking at the trends, this is how you can manage what's happening. My budget says my unit cost should be decreasing. It's actually increasing here. That would ring alarm bells for me if I saw that in a management meeting, and I'd be wanting to know why. Is it because our costs have increased? Is it because the number of participants has decreased? But by using that as a KPI, you can tell that there's a problem there. So KPIs are very good as early warning signs of problems so that you can then take action, make changes, and improve things in the organization. And net equity, actuals compared to budget, and our budget was that our equity was going to increase. We obviously haven't been as profitable as we expected. And I know occasionally you get somebody in a not-for-profit organization who says you shouldn't be making profits. It's not that you shouldn't be making them, it's what you should be doing with them. And we all know rainy days come, and rainy days are here for many people at the moment. Now, I'll come back to how to create those reports shortly, but let's go and look at a couple more examples of operational KPIs. And those of you who are member-based organizations, it's important to know how many members you've got. Is it growing? Is it shrinking? And member churn is looking at the number of members you've lost as a percentage of the total member count. So it's about keeping track of how many members you've got, how many you're losing each month, so that, you know, and in all membership organizations, there's going to be some churn. You know, people come, people go, they move to different areas and drop off their membership. But if you get an unexpected increase in churn, then maybe it's or a long-term consistent rise in the churn rate, maybe it suggests that you're not meeting the needs of your members and you need to reevaluate how you're looking after them. It could be as simple as the person on the front desk just being rude to people. It could be that if you're a theatre group, you're no longer providing the type of theatre shows that people want. On the other hand, it could be that there's a virus out there and nobody's got any money and you're not allowed to put on any shows, but we'll leave that one for another day. Wages to income. Wages is a big part of the expenses of most not-for-profit organizations because they're service organizations, yeah. So, and service requires people, but that still needs to be managed. You still need to know how that relates to the budget, and not just the dollar amount, because by looking at it as a KPI and comparing wages to income, it gives you a measure of the percentage, so that you can look at how, as the income grows, does the proportion that you're spending on wages grow proportionally? Is it less? Is it more? That sort of thing. And similarly, admin to revenue, a lot of, especially organizations that are funded by donations, there's often a lot of concern in the press about how much people spend on administration, with sometimes people not realizing that administration is essential to good management, and you can't manage an organization well without spending on administration. But from an internal perspective, it's still important to monitor so that you know whether that is increasing, decreasing, you know, and doing it as a percentage of your total revenue gives you perspective. So let's just have a quick look at how we create those. So the membership one, if I just go to my workspace, again, I've used metrics for that. And I've got metrics here for current members, new members, and lost members, so that you can measure those as a proportion of the total members. And then the KPI, again, if I just, so current members just picks up that metric, so that's simple. And member churn is just dividing, so lost members divided by current members. And this is a good way of just knowing how well you're servicing your members. Are you keeping them? Are you losing them? And how well you, it's a good metric for how well you're looking after your members. So worthwhile for, you know, any sort of membership based organization. Then wages to income is one of our standard KPIs, and we actually call it wages to turnover, but it's just wages divided by total income. And admin to revenue is admin divided by total income, and admin is an account group that I've created here and just specified which of these expense accounts I'm counting as admin. Yeah, so that you can then measure that, compare it to previous years, compare it to budgets, that sort of thing. Let's, where was my reports? So I think I've got those at the top. So my current members, by using that as a metric, I can see trends of, is that growing? It was growing fairly steadily, and then it's dropped off. Yeah. And again, if you're getting that as part of your board reports, that will prompt questions. What did we do in March to suddenly lose that many members? And here you can see that churn percentage. You know, it's mostly been around 2%. We had some months where it was 3%, and in March it's jumped up to 5.5%. Again, it's something that will then set alarm bells ringing so that you can start looking at this stuff and saying, what are we doing wrong? What should we be doing better? How do we keep those members? How do we keep them happy? And, you know, at the end of the day, these KPIs are only useful if they prompt you to take some sort of action. Yeah. Wages to income. It looks like it's fairly variable in this organization. That's sometimes the problem with sample data. And it's also consistently well above budget. As a board member, I'd be shocked to get that, but I'm sure yours won't look that far out. And admin to revenue, same sort of thing, actuals compared to budget. So a year ago, we were consistently under budget, but now it looks like we budgeted for a lower admin ratio, but the actuals are much higher than we budgeted, although not greatly different from last year. So, but it would prompt a discussion and get people thinking about what's happening in the organization. And at the end of the day, when you're giving people reports, you're giving them information, you want them to think, you want them to discuss what's happening, and you want them to make decisions to improve things. So let's move on to the next couple. So cash flow KPIs. And cash flow is particularly important at the moment. I mean, cash balance is simply how much money have you got in the bank. And, you know, it's simple, it's basic, but, and it doesn't, on its own, it doesn't tell you how long that's going to last, but it's a good starting point, and it's something that people can relate to, especially if you've got a board with non-financial members. You know, not-for-profit boards aren't generally well populated with accountants and people with financial knowledge. People get on boards because of their commitment, their skills, their knowledge of the cause, the sector that you're in, not necessarily because they're, you know, got good accounting or business knowledge. So cash balance is something that is very easy for them to understand, and again, looking at trends in that will tell you whether it's declining, increasing, and how much of a buffer there is there. The number of days cash reserves gives you a bit more information. Essentially, that's how long can your organization last if your income stopped today. So it's basically looking at your average daily expenses and how many days that would last for. Now, in the past, this has typically been a fairly theoretical scenario, and most of the time it was about, you know, have you got 30, 60, 90 days cash reserves? And mostly in the context of, if we've got 90 days of cash reserves, then while our income's unlikely to drop to zero, if it dropped 50% because we lost some major funding or something like that, then we know that we can probably last 180 days. And I don't think too many people really envisioned a sudden total stop in income, but that's essentially what's happened to most sporting clubs at the moment. the membership income has stopped, sponsorship income has stopped, ticket sales for games, same for arts organisations. So knowing what cash reserves you have and how many days it's going to last, I think the current crisis brings home to us the importance of that, and having those reserves and being able to survive, whether it's a lockdown that goes for 3 weeks, 3 months, or 6 months, and knowing what you can do and what assistance you need to get through that. Working capital is about, it's a fairly business related term, but it's about looking at your current assets, which is the things that you can turn into cash fairly easily. So things like bank accounts, your debtors if you have them, inventory if you have stock that you sell, those sort of things, and comparing them to your current liabilities. So the trade creditors, so what you owe your suppliers, credit cards you might have, short-term loans, that sort of thing. And generally you want those current assets to be higher than your current liabilities, and it's a good measure of the liquidity of the organization. And again, a drop in the working capital ratio can be an early warning sign of potential cash flow problems coming up. And then creditor days is about the average number of days it takes you to pay your suppliers. Again, that will, there tend to be sort of sector standards for that, and the not-for-profit sector generally tends to be fairly good at paying suppliers, but as a board member, it's again one of those early warning signs of potential cash problems when the average creditor days starts creeping up. If you used to pay everybody within 14 days or within 30 days, and now it's stretching out to 45 or 60 days, why is that? It's, if I was seeing that on a board report, I'd be asking questions. Why can't we pay our bills? Do we have problems? Is this something temporary, or is it something long-term and structural that we need to deal with? But, again, it's one of those things that will prompt questions, and, as a board member, get you thinking. And you don't have to be an accountant to look at those numbers and say, okay, we used to pay our suppliers in 14 days, we're now paying them in 45 days. I can understand that's a problem without having to have a degree in accounting. Whereas if you show me a balance sheet and I see the creditor number on there and I've got nothing to compare it against, I may not make that same connection. So I think the KPIs help by extracting that financial information and make it simple and understandable to non-accountants. Let's just go back to my chart, and I should have some charts of those. No, let's skip through those. We've looked at those already. So cash balance. In this case, our budget was that we were going to increase it fairly considerably, but it stayed stable. But at least it's higher than it was last year. It's not as good as the budget we set. And in terms of calcs, cash balance is one of our inbuilt KPIs. You can tell the inbuilt ones because they've got a padlock there and they're read only, but it's using the default bank account, which is the accounts that you've nominated in the financial settings here, financial settings bank, and you can nominate multiple bank accounts there. So if you've got multiple trading accounts that you use on a day-to-day basis, it's the combination of, in this case, those 3 different bank accounts. So cash reserves in days, this is a little bit more complicated. And you'll see in this example, we're up around 250 days, which is plenty. That means, well, normally I'd say that's plenty. If you're in the international tourism business right now, you might not think that's sufficient, but there's not too many not-for-profits in the international tourism business. But that'll give us 8 months of coverage of our expenses in the event of a total stop of income. And the normal benchmark of what's reasonable there is generally considered to be around 90 days. If you've got 90 days cash reserves, that gives you time to arrange alternative funding. It gives you time to potentially reduce your expenses, that sort of thing, and take action. And as I said, most of the time, most of us don't expect a total sudden cessation of income, but we now know that that is possible and it can be quite widespread. So in terms of how this KPI is calculated, cash reserves in days. So the actual formula here is cash reserves. This one's a bit longer than most of them. So it's cash reserves divided by annual expense minus non-cash expenses divided by 365. So I've taken my total annual expense and taken off the non-cash expenses because I don't want to include things like depreciation, amortization, because it's only the stuff that we're going to actually have to spend money on. And so in account groups, so annual expense is one of our built-in account groups that just takes the total, all your expense accounts, and for the last 12 months. So it's using the annual movement for the last 12 months, and then I've created one for non-cash expenses, and you'll see I've included things like unrealized currency gains, amortization, depreciation, that sort of thing, because they're not going to affect how long our reserves will last. And where are we again? And cash reserves. In account groups, I've created a balance sheet group called cash reserves, and I've taken there not just our normal trading accounts, but also any short-term investment accounts that we might have, because I mean that's often where you store your cash reserves. You don't keep $1 million sitting in your day-to-day trading account, apart from the risk of somebody getting access to it. You're not making any interest on it. Not that you get a lot in a term deposit, but you'll get something. So typically you would include things like term deposits there. It wants to be stuff that can easily withdraw, and most term deposits, even if they are a sort of fixed 6-month, 12-month term, there are methods of getting early access to those funds in the event of a crisis. There might be some cost to that, but you can still get access. So I've created an account group there, which is a closing balance type, and nominated my bank accounts. And then, as you saw, I will give you these formulas afterwards. So it's just, so I'm taking the annual expense minus the non-cash expenses, dividing that by 365 to get the average daily expenses, and then dividing that into my cash reserves, and that's giving me my number of days that we can survive without cash. Working capital is one of our built-in KPIs. So if you're using Calc, so you don't have to create that. And basically it's current assets divided by current liabilities. And that's an easy one to just pull out of your accounting system. Most accounting systems will have some sort of, well, maybe not zero because it doesn't have headings built into the chart of accounts. But if you're using QuickBooks Online or MYOB or something like that, there'll be a heading for current liabilities and current assets, and just divide one by the other. And again, the benchmark there is that you want that to be greater than 1 or greater than 100%. Some people express it as a percentage, so 100% or 200%, which is the ratio of one to the other, or some people just express it as a number, 1, 2, 3. And in this case, I've got 560%. So that's healthy. If the working capital ratio is less than 1, it's usually a signal of upcoming cash flow issues. Doesn't mean you're going to go broke. It just means cash is going to be tight, and you may have problems paying those outstanding liabilities, the credit cards, the creditors, that sort of thing. And then creditor days, again, is one of our built-in KPIs. So if you're using Calc, you don't have to set that one up, it's already there. And it's basically the trade creditors from your balance sheet divided by creditor expenses. And so that's all those expenses that all those expense accounts that you get on credit. So it doesn't include things like wages and wage related stuff that is paid out through the payroll system. It doesn't include the accounts where you may pay everything cash, for example. It's only the ones that are paid on credit. And again, I mean, in this case, I've got 102, 111, 106 days. That would probably be considered unacceptable in most places. So there's my working capital ratio, up around 5. That shows a healthy liquidity. It means current assets are more than 5 times current liabilities. So in the event of needing to pay out those liabilities, we've got the ability to do that easily. If it was down below 1, it means we'd struggle to do that. We may have to sell fixed assets or bring in other long-term funding for that sort of thing. Creditor days, if I was a board member looking at this one, I'd be horrified with over 100, taking over 100 days. But I've seen big organizations, not so much in the not-for-profit sector. It doesn't. Most not-for-profits are fairly responsible about paying their suppliers, but again, it's the trends that you want to watch for. It's when you see it going along steadily and then suddenly jumping up. Why is that? What's going on? Why can't we pay our bills? Why can't we pay our suppliers? What's that doing for our relationship with the suppliers? So with many of these KPIs, they're early warning signals that alert you to upcoming problems. And I think that's where KPIs become most useful. Just quickly, we're almost out of time. would just show you how to add KPIs onto reports in Calxa. If you select KPI, now a couple of things. I'll show you a chart first, and let's do a bar chart. If you use, there's a couple of different ones. There's the KPI analysis one has an option of having a grid at the bottom, and the multi-period one will run monthly or quarterly or annually. So you can do multi-year reports there. It defaults to starting at the beginning of the financial year. If I just choose my wages to turnover there, because I know there'll be some numbers on that. But what I like to do with my KPI reports is, rather than doing them on a financial year basis, I tend to start them 12 months ago. Oh, if I click the right button, I'll get what I want. I start them 12 months ago and run them for 13 months. And I'll explain why I do that in a moment. There is logic to it. But if I just pop that out to another tab. So in this case, I'm reporting on March 2020. That's the month I'm interested in. But because I've run it for 13 months, I can compare it to March 2019 as well and see the trends for the 12 months in between. So that's why I like that as a 13-month report. And just while we're here, in Calxa, you just then add that to a report bundle, and I'll add it to my KPIs for not-for-profits, call it wages to turnover, or revenue will do. Make that the title of the report, add that report to the bundle, and the way report bundles work is that they save all the settings, so you don't have to think about them before anymore each time you run it, and you can just change the order there just by dragging it up and down. And each month you just come along and change the month at the top here and run that bundle, and it's simple. Once you've set up that bundle of reports, it's simple to deliver it each month. Now, and one more. If I want a KPI, you can add KPIs on the bottom of a lot of the actual to budget reports. And in the filters here, you'll see show KPIs. And again, you can just search for them, select the ones you want there. If I refresh that report, pop it out to another tab, and the KPIs show in the additional information section at the bottom of the reports. There you go. So after the net profit, we've got additional information, and there's my wages to turnover KPI showing actuals, budget, variance, and in this case, it's showing the month and the year to date. So, questions?
Hey, Mick,
Nobody
Eric
asking
here.
any questions, Eric?
We haven't had any questions yet. No, look, now's a great time to ask any questions if you've got any late minute ones, guys. What I'll do is I'll go through the outro. I'll let Mick have a few last words here. And if there are any questions that are come through, we'll see if we can tackle them. So look, thanks very much, Mick, for presenting today. And thanks everyone for joining us. Hope you managed to learn a lot from this. If you've got any questions that come to mind, not in the next few minutes, but later, or any other feedback, send us an email to events@connectingup.org. We'll see if we can tackle that offline. Mick, have you got any contact details that you want to share here, or?
If I was good, I would have, wouldn't I?
No, that's all right.
Yeah, calxa.com is the website. So calxa.com is the website. Our contact details are at the bottom here. There's a 1-800 number for those of you in Australia, 0800 for those of you in New Zealand, and if you happen to be in Townsville and you're allowed to talk to people, feel free to drop into the office. And just wanted to mention our donation program, which is available through Connecting Up or TechSoup, depending on which country you're in. And there's information on that on the website as well. And yeah, talk to us if you need help.
Brilliant. Thanks, Mick. And likewise, if anyone has any questions on the donation or the discount for CalCSA through the Connecting Up or TechSoup New Zealand website, you're on it, you're a member already, you're not quite sure where to go next or what you should be looking at ordering, feel free to have a chat to our customer service team. Just reach out to us. We're happy to clarify. Look, otherwise, obviously the recording for this and the slide deck will be up on the website later, so keep an eye out. We'll email you a link to that as well. Otherwise, it looks like we haven't got any questions here. So yeah, thanks for being with us. Thanks again, Mick. Enjoy the rest of your day, everyone. We'll give you a few minutes back, and we look forward to seeing you all next time.
Okay, thanks everybody. Stay safe.